Good afternoon everyone and welcome to the Morrows Monthly update for February. Despite some late volatility, the month saw positive returns across most asset classes and also saw the continuation of the upward trend that we've seen since June 2012. A generally stronger than expected earnings season saw some equity markets move higher for the month. Australia was up around 4% as was Japan, and the US was up around 1%. Weaker economic data out of Europe and China saw their markets down around 5% and 2% respectively. Bond markets have been relatively subdued over recent months. However, uncertainty around the recent Italian election has seen a spike in Italian bond yields and also Spanish bond yields. Safe haven bond yields did decline as a result of this. On the commodities front, oils continued to fall, down around 4% for the month, and despite a late-term rally, gold was also down around 3% for the month. Most other commodities were flat to marginally down. The risk-on trade has continued in equity markets, although we haven't seen that flow through to the Aussie dollar, down around 2% against the US dollar. It has remained at multi-year highs relative to the Japanese yen. Whilst the US still faces political headwinds, economic data has been improving. Manufacturing data was better than expected, we saw consumer confidence rise, and we also saw the housing market continue its recovery. On the downside, unemployment did rise to 7.9% for the month. In Europe, economic data continues to be sluggish. Manufacturing and services activity continues to contract, although Germany has been a bright spot with improved investor sentiment. In China, data was relatively subdued as their New Year celebrations effectively shut down the market for a week. Manufacturing came in slightly under expectations, although inflation still remains under control. Domestically in Australia, we've seen an improvement in consumer and business confidence and also better than expected employment growth. The RBA kept rates on hold at its March meeting, and whilst the market is looking for further rate cuts, these may be some months away as the economic outlook seems to be improving. – 2013 has started out strongly for most asset classes, with back-to-back gains in January and February. That being said, markets still remain fragile, and we were recently reminded of this with the uncertainty that surrounded the Italian elections and also the hint by the US Federal Reserve that stimulus could be removed sooner than expected. In this environment, macro headwinds still remain, and we want to position our portfolios conservatively in that environment. We're still focusing on downside risk protection, and we're achieving this via our market neutral and variable beta strategies. We're also in the process of implementing several new manager changes, and we'll be looking to roll those out over the coming weeks. We thank you for your time, and we look forward to talking to you again next month.